weathering the storm, thriving. Today's webinar, we're going to be discussing funding Lifelines. There's been a lot going on with COVID, as well as a lot of the other things that are going on in the communities right now with all of the fires and a lot of the difficulties that the police officers and everybody is going through right now. But we'll also, today's webinar, we're going to be focusing on some of the difficulties and some of the options for funding after all these businesses have received the PPP funding, and now that it's getting to ready to, everybody is getting to the end of their funding. What are some other options that are out there that are available to our small businesses to be able to continue to fund their businesses during, if they're still in the middle of a shutdown, they're getting ready to open up, or they're still seeing some continued cash flow crisis. We're excited today to have Robert Spindlove. He's the Senior Vice President and Economist for Zions Bank. Robert frequently advises briefs, policymakers, and well as businesses and civic groups throughout the United States. He is regularly called on to give expert analysis in the media through print, radio, and television. He's also known for his insights and understandable approach to explaining economic trends. And Robert's going to be discussing what's kind of going on in the economy today and how that will impact our banking and our lending for the future. We have Nabil Instafamous, and he is with Celtic Capital Corporation. He's the Vice President and JD of Client Business Development. Nabil will be sharing some of the opportunities and programs that Celtic Capital provides to its banking for funding. We also have Libby Addington. Libby is a business developer for MoFi. MoFi, we're excited to hear more about what MoFi does, and Libby is the development of strategy and drives awareness for the products and services that MoFi provides to the community. We're also excited to have Kathleen Mingo with us. She is the founder and CEO of Crowdfund Better. Kathleen has been featured in the Wall Street Journal and Forbes, and contributed to industry publications like Crowdfund Insider and Local Investing. We're excited to have each of the panelists on today, and we will be starting with Nabil from Celtic Capital.
Thank you, Cheryl. I'm very pleased to join this great panel this morning to talk about alternative capital financing beyond traditional bank financing. I'm with Celtic Capital. I cover the Pacific Northwest. We're a leading asset-based lender, a national, we place loans nationally, although we're based here in the West Coast. And I've been with Celtic about 1.5 years, but Celtic's been around over 35 years. So we're well known in the industry. And I'll be explaining a little bit more about asset-based lending and the kind of programs we provide. First, before we talk about that, I'll talk about alternative capital financing. That's sort of a broad category of financing. Let me just do this. There we go. Can we see the slides? All right, it's a broad category of financing that covers a variety of kinds of lending typically, and also equity financing that goes beyond traditional bank financing. And a variety of companies for reasons that completely make sense when I describe why banks do what they do. Companies will find themselves needing other kinds of financing beyond lines of credit or loans secured by real estate or other assets that they can get from traditional banks. There's all kinds of alternative capital financing that comes from everything from credit cards, factoring, there's government programs, crowdfunding, which you'll hear about today, term lines of credit, getting loans from family or friends. But I will be talking about asset-based lending. So before we start, what is asset-based lending? It's asset-based lending essentially is lending that is secured by the assets of a business. We focus on B2B companies, companies that sell goods or services to other companies, rather than retail or consumer-facing businesses, because those are the kinds of assets we focus on, those kinds of businesses, because they have the assets that we feel comfortable lending against. Typically, the whole asset-based lending will typically lend against accounts receivable, inventory, equipment and machinery, and also real estate that is owned by the company. So who can benefit from asset-based lending? Well, essentially any company that can't get bank financing, that typically is either they're fast growing, an emerging growth company that's growing very quickly, and so banks can't keep up with their growth. Also, those companies typically do not have consistent profits. They're typically pouring profits back into the business, and they have ever increasing needs for working capital because they're growing so rapidly. Or a company that's in a turnaround situation. They had recent losses, they're breaching their financial covenants, they may be undercapitalized, so they don't have enough equity in the business, or they just frankly, in an industry that's just not favored by banks. Those are a variety of reasons why banks, which lend based on, their source of funds, of course, are FDIC insured deposits. So they must make essentially risk-free loans that are not likely to where they would suffer losses, which makes sense. Their funds are either depositors or taxpayers in the form of getting funds from the Federal Reserve. So in both cases, banks are regulated and are watched very closely. So they are they're intended to provide capital to companies that are mature, profitable. That they'll be able to make the repayment. The variety of asset-based lending, these are kinds of financing that are related to asset-based lending. Beyond what we provide are ABL lines of credit and term loans secured by equipment. However, there are some lenders out there that are providing factoring. What they do is a little different. They're actually purchasing accounts receivable and typically notifying customers that they've purchased those accounts receivable. Under the UCC code, they're protected and they own that accounts receivable, so that if a customer who received a good or service pays a factor's client, they're actually violating the terms of what's under the UCC. They're supposed to pay the factoring company directly. And so if in those cases, the factoring company are able to notify, once they've notified a customer that, we purchased this accounts receivable, you're required to make payment to us. If they made payment to the supplier first, then, they'll go after them and say, no, you need to pay us first. So that's, typically companies will try to avoid factoring if they can. If they can qualify for an ABL line of credit, that's their preferred option. There's also something called purchase order financing. That's typical when a company needs capital prior to what they can get from an ABL lender, meaning an ABL lender will lend against accounts receivable, which requires them to actually ship the good or complete the service in order for there to be accounts receivable that they can borrow against. However, there are times when they get a very large order from a customer and they need to, for example, purchase supplies from their suppliers. They'll need capital before they actually ship product or service, before they actually have the receivable. So in those cases, you need a purchase order lender. There's also hard money lenders out there, what I call, they're also an asset-based lender, but they focus on real estate. Unlike Celtic Capital, we don't lend against real estate. So we often partner with real estate lenders in those situations when a company has real estate that they want to borrow against. There's also other kinds of lenders out there that aren't asset-based. They're like, for example, revenue-based financing. They're just looking at companies that have future streams of revenue, and it's pretty predictable. The classic example are software as a service companies. They have subscriptions, software subscriptions. So in those cases, there's future revenue streams, and a lender feels comfortable lending a certain amount of money, and it's paid back over time. And then similarly, there's merchant credit advances. Those are for merchant cash companies. They will typically take payment either daily or weekly straight out of a bank account against often credit card receipts. So they're often available to companies that typically obtain their payment from consumers directly. So restaurants and hospitality are great examples. Those kinds of companies, if they need a short-term infusion of cash, they may go to an MCA loan, but they have to be extremely careful in those cases. Merchant cash advances are never quoted based on APR, and the rates on those types of financing can be really significant, very expensive over time. So when we talk about asset-based lending, it typically falls in between what I would say traditional bank financing, traditional debt. Of course, companies, if they have the kinds of balance sheet and income and consistent profits over time and can qualify for traditional bank debt, that's usually the preferred option. It's usually inexpensive. We'll talk about that a little bit later, but it's the cheapest form of financing available, but it's also the safest and least flexible. Equity on the other end of the spectrum is, it's for many companies, that's their best option. But I always say you should look for equity, not just for the capital, but frankly for the partnership. If you're getting equity from an equity source, you want that you're essentially choosing a long-term partner in your business. And you want them to provide other benefits beyond just the capital. For example, they've got relationships, they can increase sales, they open doors, they can provide expertise that isn't available on your team. Maybe they've got experience scaling multiple companies, so, like a private equity firm, and they've got executives on the bench to help your company grow. Those are the kinds of reasons you would seek equity capital beyond just the capital, because if you think about over the long term, that is typically the most expensive form of capital, because if your company is growing, for example, 5 years from now, and you expect revenues to be 4 to 5 times greater than it is today, well, the $1 million that you got today in equity would be worth $5 million, at a liquidity event 5 years from now. So, I always tell folks to be very judicious, careful, selective when they're thinking about equity partnerships. ABL falls in between. Again, it's secured financing. It is typically more expensive than bank debt. And here's a slide that talks about the two, but it's typically more expensive. The nice thing is it's very flexible. As you grow and your accounts receivable grows, typically your availability of funds that you can borrow also increases right alongside. On banks, on the other hand, they will typically go through a long underwriting process. Even to increase a line, if the underwriters have to go through a formal process, typically they only do it once a year. So it's a very different process in order to increase your borrowing capacity on the bank side, but ABLs will just grow alongside your business. In both cases, money can be available fairly quickly, next day or same day when you need capital against your line of credit. Of course, banks, like we said earlier, startups or companies with not the greatest financial history are not going to get traditional bank financing, but an asset-based lender that looks at the assets first as opposed to cash flows, they would likely qualify. Banks have financial covenants, a lot of restrictions, whereas an ABL line, typically like us, for example, we don't have any financial covenants. We don't have restrictions on lending typically. What we do, again, is we're looking at the quality of the assets. We've talked a little bit about ABL financing versus equity. I won't go too far into this, but like I said, equity is something that you should think about very carefully. Again, think of it as bringing in another business partner. Salte Capital, who we are, we provide loans and lines from $500,000 to $5 million. Again, secured by accounts receivable, inventory, and equipment. Our target borrower, of course, come from all kinds of industries that can't get bank financing. What we won't do is, typically, like I said, consumer-facing businesses like retailers. We don't do medical insurance and medical-related receivables, hospitals and the like, and clinics. There are specialty lenders that I know. If I ever come across a company that's in that category, I know where there are specialty lenders that focus on that industry. We also don't do progress billing. That's also a very difficult kind of receivable. Progress billing is, for example, traditionally in construction, the subcontractors are paid based on milestones or over time, over a project. They're paid periodically as time goes on, but they haven't completed the project. So in our case, we wouldn't feel comfortable lending against those receivables because if there's any dispute as to the quality of the work done or whether the milestone was completed, the customer likely will not pay at that time. So we don't feel comfortable that that's a true receivable. But there are lenders out there that specialize in those kinds of financing, construction lenders, or project-based financing. I typically will send those kinds of companies to those lenders that focus on those kinds of companies. Like I said, our solutions are lines of credit secured by accounts receivable and inventory. When we look at accounts receivable, that's one of our most common forms of financing for lines of credit. That is, we're looking at the quality of the accounts receivable. For example, we're looking at the average turn. How long does it take for your customers to pay you? And if, on average, if it's less than 50 days, you'll qualify for the maximum advance rate, which would be 85% in our case. We look at whether there's dilution. That means whether your customers pay the full amount on the invoice, or do they, short pay? Do they take back an allowance for perishable goods, for example, or do they take back an allowance for returns? In those cases, if it's a significant amount of percentage, then we will typically lower the advance rate on accounts receivable. We also look at aging. So if some of your customers are slow in paying, and in our case, slow means if it's over 90 days due since past the invoice date, we typically call those receivables ineligible, and so they're no longer qualify for financing or for advances against those aged accounts receivable. So we're always looking at aging reports and see how many of their customers and how many of their invoices are over 90 days. That will reduce the amount of available AR for their line of credit. When we lend against inventory, we focus on what is the nature of the inventory. As a financial provider, we're looking for inventory that if need be, if we had to liquidate, that is seize the inventory and sell it, we'd have to be able to feel comfortable that there's a market to sell it. So we look at the inventory if it's like custom made parts for one specific customer. In those cases, we would say that's ineligible for financing. Also, work in process. So, items that are still being made, they're on the line, they're in the process of being built, but they're not, not complete. Those also are not of any value to a provider, to a financer like us, so we wouldn't consider that eligible for financing. And then we look at the nature of the raw materials. Sometimes raw materials are valuable. So, big, large metal sheets or different forms of metal, different forms of, if you're a packager and you have long sheets of paper or cardboard, those are typically raw materials that have a market value, and so we would feel comfortable lending against those. So we would determine, what amount of their inventory is eligible for financing, and then we would advance funds based on that. In our case, the advance rate is much less than in the case of accounts receivable. We'll go up to 50% in some cases of the cost of the inventory. And that will provide additional capacity for borrowing for our clients. We're also an ABL lender that will also provide term debt secured by equipment and machinery. So for example, a manufacturer may have lots of equipment and machinery in their plant, many of which may have already been fully depreciated, and so on their books has no value, doesn't show up on their balance sheet, but clearly there is value. So we will typically do an appraisal, determine the auction value of that equipment, and we'll lend against it. In our case, we'll advance 75% of the equipment. We will amortize those loans over 5 years typically, and that'll give much needed capital to companies. We'll also provide financing for new capital expenditures, but those are only for our clients for which we already have a line of credit. And if so, we'll typically lend some advance rate for the purchase of new equipment. And we're also one of the few ABL lenders out there that can do an equipment-only financing loan. So that means we'll split the credit with another specialty lender, or we'll split the credit with a bank even. So maybe some other lender, the bank may have a line of credit, they feel comfortable with that, they may have a real estate loan, but there's lots of used equipment. They don't feel comfortable lending against used equipment, but we'll do a term loan just on the used equipment. We'll have a first lien on that equipment, and the other lender would have a first lien on all the other assets. And that concludes sort of my discussion of ABL lending generally. What I would say is if you're in the market for talking to an asset-based lender, you ought to do some due diligence on them as well, just like they're doing due diligence on you. It'd be, I would recommend that you work with an experienced lender, a lender that's been through multiple business cycles, through multiple recessions. In that case, that they'll feel comfortable lending in that environment. They know what they're doing. You want a lender that will work with you in case there are difficulties. How quick are they in making decisions? Are you dealing with decision makers quickly? Or are there so many layers of management such that for you to get a decision on a request, it takes them too much time, and therefore you can't get accommodations timely. In our case, we don't provide, we don't require any financial covenants. We also don't require any lock boxes. So our clients have dominion over their, for example, their customers who provide paper checks can still continue to mail those paper checks to them so that they can post their collections immediately in their books. But some lenders, other specialty lenders often require lockboxes. And then I guess most importantly, I would ask for references, ask for lists of your current and past clients. That's a good way to determine, to really get an unvarnished opinion about how easy is the lender to work with. And be wary if a client feels uncomfortable giving you any names. In those situations, you're typically choosing a partner and working very closely, particularly if you have a line of credit with them. You may be drawing funds, twice a week, if not more frequently. And, you need to be able to work with that lender. So that's a seamless process. I guess, that concludes my remarks. I have my contact information. If you have any questions about ABL lending generally or about Celtic Capital and what we can provide, you can, of course, reach out to me. If I'm not, if we can't help you, I certainly can suggest other lenders, other forms of financing that maybe fit your scenario. Thanks.
Perfect. Thank you, Nabil. A quick question for you. How does businesses determine what type of financing? You provided us with several different options. How does a business determine which one fits their needs the best?
Yeah. Well, I mean, I would first, obviously, it's really good to work with outside expertise. So, for example, a Rectify is a great example. Cheryl is, an experienced CFO and, or any financial advisor knows a lot about the different kinds of financing and lending. If you have a trusted advisor, I would recommend asking them. Like I said, typically companies go first to their bank and their banker and sees if they can qualify for bank financing. Hopefully their banker's been educated about other kinds of financing available if they have to turn them down, and then they can make a referral. We get a lot of referrals from bankers and financial advisors. That's how we operate. There are other lenders out there that primarily get their referrals from brokers, but we also will work with brokers, but that's not our primary referral source. But I would just talk to people in the lending community. Like I said, if you talk to me and I said, well, I'm sorry, you just don't have accounts receivable that we can lend against, or you're so concentrated that you need to maybe talk to a factor, or maybe they qualify for a community lender like MoFi or crowdfunding. I'm happy to make those referrals. We're all pretty educated about the kinds of financing available.
Perfect. Thank you very much. Just to remind everybody who's watching today, if you have questions you'd like to ask, you can put them in the chat, and we'll also be opening up after the session any questions at that point. Thank you, Nabil, so much. Now we have Robert Spindler with Zions Bank.
Great. Thanks so much for having me. It's I think this is a really important format, and it's an important time to be kind of getting a better understanding of what's happening in the world around us. So what I want to do is just kind of give a brief overview of what we're seeing in the economy right now. It is a very unique time. We've really never seen the kind of economic conditions that we're seeing both nationally and regionally in our state. It really is very unsettling, and what's so interesting about it is the kind of conditions that we see. It's pretty clear that we're in a recession. Now, it's not declared yet. We usually don't declare recessions until after they occur, but it's very clear that we're in one. And the conditions that have led to where we are today usually take months or quarters or even years to happen. And this happened in a period of weeks. And so the shock of this is truly unprecedented. And I'll show you that with some of this information. We've seen a dramatic impact on individuals and workers. Our gross domestic product is falling dramatically and is expected to continue to fall into the second quarter. And then, and what no one knows, if anyone can tell you how we're going to come out of this and when, they don't know what they're talking about. We're all trying to figure this out right now, and just trying to get the kind of information to truly understand it. So to put it in perspective, what I'm showing here, this is our monthly jobs report. We'll have a new one coming out on Friday for the month of April, for the month of May. But the April data just shows how dramatic this is. So if you look over on the left side, you can see the Great Recession. And during the entire Great Recession, our nation's economy lost just under 9 million jobs. In the last month alone, the economy lost 20 million jobs. We've never seen this kind of shock before. And like I said, we've never seen this dramatic of a shock before. When we look at our unemployment rate, again, the highest level from the Great Recession, which shows in about 2009, was right around 10%. The highest unemployment rate we've seen on record was just above that, about 10.8% in 1983. Last month came in at 14.7%. So our records only go back, this data series only goes back to 1955. So we've never seen anything in the time period that we watch. Now, anecdotally, we know that unemployment was higher during the Great Depression. And I expect that when we see the new data for May, we may see numbers rivaling those not seen since the Great Depression, north of 20%, possibly as high as 25% unemployment nationwide. Now, the problem that we're running into is our economic data is struggling to really reflect what's happening. That top line unemployment rate, as high as it is kind of understating the real impact. To really understand that, you have to look into other indicators. So what I'm showing here is what we call the underemployment rate. So the blue line is the top line unemployment rate. The green line is our underemployment rate. So that includes people that are working part-time for economic reasons, and what we call discouraged workers, people who have quit looking for a job, but they would take one if one were available. That underemployment rate is already approaching 23%, much higher than we've seen in past recessions. And then a broader measure of our labor force impact is what we call the labor force participation rate. So that's the ratio of everyone who's working or looking for a job compared to the rest of the population. So if you're either working or actively looking for a job, filing for unemployment, you're part of the labor force. And if you've given up, and if you've if you're not engaged at all in the labor force, then you're on the other side of that rate. So our highest rate ever was in 2000, when we had 67.3% labor force participation. We were hovering right around 63 for several years and kind of trending up again until April. And April dropped all the way down to 60.2%. That's the lowest level we've seen since the early 1970s. It is a dramatic drop. Not the lowest in history, but the biggest drop we've ever seen. However, when we look at this is the employment to population ratio is at an all-time low. It's not only the biggest monthly drop, but it's the lowest level we've ever seen. The employment to population ratio is the ratio of people who have a job to the rest of the population. Again, topped off in 2000 around 64%. Last month, we're now at right around 52%. So all indicators of the labor market are showing dramatic, steep drops, and I would expect to see similar trends again when we get the May data in a few days. Where are we seeing it? You can see how dramatically the leisure and hospitality sector has been impacted by the pandemic and the economic result of that. Nearly half of all leisure and hospitality workers have been laid off just in the last month, or excuse me, just in the last few months. But all sectors of the U.S. economy are contracting now. If you go back just a few months, back in January, most of the sectors were seeing very strong growth. They were expanding very well. Our biggest struggle back in January, I mean, it feels like it was 10 years ago, right? But it was a couple months ago. A couple months ago, our biggest struggle was a labor shortage. And now we're seeing widespread job losses throughout all industries. Now, one of the kind of glimmers of hope is in the survey that was conducted as part of this. The question was asked, are you still connected to your employer? Meaning, do you expect to be brought back? About 70% of workers said they expect to be brought back. So that's one of the critical aspects is kind of moving forward as policymakers are discussing this, is that we've got to work to get those 70% back working and back connected with their employers and their businesses. So this is the looking at the NFIB Small Business Optimism Index, and you can see there was a big jump in 2016 after the election of 2016. A lot of confidence in where the economy was going, a lot of confidence in the future of the economy, and stayed at a relatively high level for several years. But just in the last few months, we've seen that business optimism drop significantly. We're now down below the level where we were in 2016. When we look at consumer confidence, similar trend. So that green, this is the Conference Board's index of consumer confidence. That green line is kind of the dividing line that I watch real closely. Above that means that people feel like the economy is prosperous. Below that, that the economy has some room to grow. And again, you see that jump in 2016 going into 2017, held at a very high level of around 130. But over the last couple months, it's dropped all the way down to 86.6. So we've seen businesses are losing their confidence in the economy. Consumers have lost their confidence in the economy as well. Now, here's a glimmer of hope, though. This is when we look at, so as part of the survey, they say that one of the questions is, how do you feel like the economy will be 6 months from now? And you see that consumers are very, have a high level of confidence in future economic conditions. So it's kind of there's beginning to be this pent-up demand. People want to get back out. People want to be re-engaging in the economy. They want to be returning back to normal. And it's just a matter of how, when, and when we can redo that to bring people back in and restart the economy in wide numbers. Now, why does the consumer matter so much? Why, a lot of this has been talking about kind of the individual level, because all of these consumers, all of these workers add up to the economy. You can see that here. This is our gross domestic product. And gross domestic product is the broadest measure of our economy. And you can see that that GDP was moving along very nicely for many years, kind of fluctuating right around that 2 to 3% level, which and think about it, this was before it ended, this was the longest economic expansion in our nation's history. We went over 10 years without a recession. And so to see that kind of growth in the economy in the late stages of an expansion was really, really good. However, first quarter, and this is a newly revised number, the first quarter, the economy contracted by 5%. Now, that may not, well, that is dramatic, but it's even worse than it looks. If you think about the first quarter, what was it? It was January, February, and March. So that the impacts of the pandemic were not being felt in January or February. So this really is the impact that the impact of the pandemic was so large that it completely wiped out all the gains in January and February and resulted in a contraction of 5% in the first quarter. And then if you look at the components, that's a really important part. So the components of GDP are color-coded in here. And the two I want you to pay close attention to is business inventories or business investment and personal consumption. So business investment had been slowing. We'd actually seen contraction in business investment for several quarters of 2019. So businesses were already starting to get nervous in mid to late 2019, and then continued that in the first quarter. But it's the consumer that really dragged the economy into a recession. The consumer is the dark blue, and consumer spending is about 2/3 of the overall economy. So if consumers are spending, the economy will do okay. Once consumers stop to spend, the economy suffers. And we see that in this first quarter number, where consumer spending went from a net positive to a dramatic downturn, a dramatic negative, which pulled the overall economy down. So that's looking at the first quarter, so January, February, March. What does the current quarter look like? And this is where we're starting to see some of those problems getting even worse. So this is the personal consumption expenditure, is just a fancy way of saying consumer spending. So what are consumers doing? In April, consumer spending dropped by a record 13.6%. It is, and just to show the context of this, so this is a graph that I've been using for several years, and I had to dramatically change my the axes on this because the drop is so huge. If you look at the green line, that's the Fed's target. So the PCE, as we call it, is the main indicator the Fed uses for inflation. And the Fed's target is that green line, right around 2%. And the last time we saw this kind of, well, we've never seen this kind of contraction. The last time we saw what we call deflation, or dropping prices, was during the last recession, the Great Recession. And you see we saw a dip in our overall prices, which caused overall deflation across the economy. And, you know, before this month, that was a huge drop. And it was if you think about what caused that, it was mostly the housing crisis. But what we're seeing now has dwarfed that. The retail sales have particularly taken a hit. Retail sales dropped 16.4% in April. And most of the impacts have been felt by places that you have to visit really to buy something. Clothing and accessory stores, furniture and home furnishing, electronics, bars and restaurants are all seeing a very large impact. Look at that, clothing and accessory sales dropped 89% in the month of April. So how are things looking regionally? And I just want to show you a kind of a comparison of a few months to show how dramatic this has been. So this is January of this year. U.S. Unemployment rate was 3.5%. Idaho, 2.8%, one of the lowest in the country. But look at the entire nation. There, with a few exceptions, almost every state had extremely low unemployment. If we fast forward to March, you see that start to change. You see Nevada. And Nevada is a really interesting one to pay attention to. Nevada was at 3.6%, jumps to 6.3% in March. And then you can see those jumping up kind of in the Midwest and the East Coast. Let's go forward to April. Every single state now has unemployment above 6%. The national rate, 14.7. Look at Nevada. Nevada is now at over 28% unemployment. That's for the entire state. And it's a dramatic change from being one of the lowest unemployment rates in the country to the highest in the country. Idaho's unemployment has moved up also dramatically, but here's one of the benefits. Idaho, as high as it has become, is still lower than the national average. Idaho is one of the lower states for unemployment. So while we're being impacted, it's not as dramatic as other states like Nevada or like Michigan. When we look at the job losses, this graph has always been the one where I show job growth, but unfortunately there are no states with job growth in the month of April. Again, Idaho's shedding a lot of jobs, but it's one of the lowest in the country at 9% job loss, compared to, again, Nevada losing 18% of jobs, Michigan losing 23%. And this is, this is in the context of we've still got another month to go. So when we look at those states with big changes, you can only imagine what we're going to see when the new data comes out at the state level. So Idaho, while we're struggling, we're also seeing some signs of strength relative to other states. Where are we seeing the impacts? Again, leisure and hospitality seeing big impacts, but it's a little more mixed than at the national level. Our natural resources sector is actually expanding. Financial activity sector is expanding. Construction is flat. And so we are seeing similar trends, but not quite as dramatic as the rest of the country. Also, one of our fundamental benefits, one of the fundamentals that make the Idaho economy strong is our population growth. Remember, Idaho is the fastest growing state in the United States, growing more than 4 times the rate of the nation as a whole. We're also in the center of the fastest growing region of the country, where we've got very strong population growth throughout our region. Also, the nature of the growth is interesting. So this is showing the components of population growth. The green being natural increase or births minus deaths, and the blue being migration, so people moving into the state. And you see that about 75% of our population growth is from people moving into the state. And I would say as we move forward, especially with this virtual world, I think there will be much more desire for people to live in places like Idaho and kind of the Intermountain West, where they're not so crammed in those big cities on the coast, where they can have room to breathe and room to move around. So I think we could actually see migration go up as a result of the changes that we're seeing. So kind of just putting it all together, I do think there are signs that the contraction has ended. The dramatic drop, we're starting to see early signs that we may have hit the bottom, but it'll still take a few months for us to know that for sure. But it has been so dramatic, so swift, and the path out is going to be very difficult. Just yesterday, the Congressional Budget Office came out with a forecast that they don't expect GDP to return back to where it was in December of last year for 10 years. So it's going to take a long time for us to fully come out of this and fully recover. Those areas that have been impacted especially will struggle to come out. Those travel and tourism, leisure and hospitality, the areas that we've seen those big impacts will continue to struggle for years to come. One of the critical parts, though, and I'll tell you, the CARES Act and the PPP program and now the Main Street Lending Program have been critical to addressing the economic crisis, and we need the feds to continue to provide that support. That's the reason we have fiscal and monetary policy, is times like right now. The Federal Reserve exists for times like right now. And it's the responsibility of our federal leadership to really kind of step in and support the economy. But like I said, the Idaho economy is fundamentally strong. We have the fundamental population growth. We have the workers. We have a well-educated workforce. And again, our biggest struggle a few months ago was massive labor shortages. And I am confident it's going to be rough and it's going to take some time, but the economy will recover. And I feel like after this is over, we may even be better off because of the benefits in our state. Thanks so much.
Thank you so much, Robert, for all of the wonderful information you provided. I do have a quick question for you. What do you feel like, we've seen kind of the wave, right, hit of COVID and seeing all the businesses kind of starting to reopen and economy starting to boost. What do you see the impact is of, they're saying that come October, we're going to hit another wave. Where do you see that happening as far as impacting the economy now? Are people still being nervous about that? And do we see another large impact hitting the economy come this fall?
Yeah, that's a great question. And that's one of the biggest struggles we're having is the economy can't fully recover until we have the virus addressed. And so until we have, until we have some kind of vaccine, some kind of treatment, again, it's all back to that consumer confidence. Even if the entire economy is open, even if we say everyone can do everything you want, if consumers don't feel confident, they're not going to go back to what they were doing before. They're not going to go on those cruise ships. They're not going to travel to Europe. They're not going to want to go to movies or to concerts. And so ultimately, we've got to have that treatment and we've got to be able to build that confidence to get people back. If we get another wave, see, I don't think we're going to see the kind of shutdowns that we saw the last few weeks. But even without those shutdowns, I don't think we're going to be able to return to that pre-recession level until we've built up that confidence and until we've adequately addressed the virus.
Perfect. Thank you so much. Right, next we have Libby Addington with MoFi.
All right. Thank you, Robert, for those sobering statistics. It makes a conversation about funding Lifelines feel more important than ever right now for business owners in Idaho. Let me just do my first slide. So a little bit about MoFi, for those of you that haven't heard of us. We are a nonprofit community-based lender. We provide financing and consulting services to businesses and projects that are not served by the traditional financial mainstream. So in plain English, businesses and projects that can't get their financing in whole or in part from a bank or a credit union. We think of ourselves as having a double bottom line because we're solving for both strong financial returns so that we can continue to do this important work, but we're also solving for an impact return. We're wanting to make sure that the dollars that we invest into people and projects are going a long way to improve communities. So we know that last year we provided over $80 million in financing, but we also know that almost 90% of that went to low-income people or low-income places. We know that 53% of our financing last year went to women-owned businesses. And that the projects that we supported created or retained over 1,300 jobs. So those are exciting statistics for us at MoFi that make us excited to get up and come to work every day. Just quickly, we are similar to Celtic Capital, have been around about 35 years, and we have offices. We started based in Missoula, Montana, but we have expanded our footprint and our service area. We now have offices in Boise, Idaho, and Bozeman, Montana, and we now serve a 5-state region in the Northern Rockies. Last year, we expanded into Eastern Washington and Eastern Oregon. And when we think about funding lifelines for business owners, I'm going to talk to you today about 2 of our main programs that I think hopefully it can be perceived as useful resources and lifelines to business owners as we weather the storm of COVID. And those are business lending, and I'll talk about 2 different kinds of business lending that MoFi is focused on right now, and then also the New Markets Tax Credit Program. Before I go on, though, I just have to shout out to Susan and Sandy of Tin Roof Tacos. If any of you have eaten there, hopefully you, if you haven't eaten there yet in the Treasure Valley, you'll have an opportunity to try them sometime soon. But they are a fantastic example of what's possible when you put capital into the hands of people that have great business ideas, lots of experience, but just can't get the loan from the bank to get started. Susan and Sandy came to us with a crazy idea to open a street-style taco restaurant in Boise, downtown Boise, in the style of one that they had worked at in Texas. And we recognized, as I said, the solid business plan. They had the experience. We made the loan, and they have just completely knocked it out of the park. They've opened a second location. And in addition to having fantastic food, I think they've gotten some accolades for best taco in Boise, but or in the state of Idaho, but they're also just really awesome business owners, caring a lot about their employees and creating jobs and bringing more prosperity to the Treasure Valley. So I wanted to quickly touch on the Paycheck Protection Program, which Robert mentioned, and I believe that there has been a session on this program previously in this series, so I won't spend too much time on it, but do want to at least make sure that all of you know as business owners that this program is still available, it's still out there. A lot of people have, I think, assumed that the funds have run out because the first round of funding did run out. But there's still actually over $100 billion available in the program nationally. So if you remember nothing else, if you as a business owner, or if you know another business owner that is in need of relief funds for COVID and hasn't been able to get them, there are still funds available, and you can look into them through us, through MoFi at mofi.org. If you aren't familiar with the PPP program, just very quickly at a high level, this is a federal program that came out of the CARES Act that Robert mentioned, that was designed to help business owners keep their employees on payroll and to get through the challenges and hardships financially of COVID. And the program provides forgivable loans if employers use the loan proceeds for eligible expenses. And those are payroll first and foremost, but also rent, utilities, mortgage insurance. We really like the program because it has such broad eligibility requirements. So businesses have to have fewer than 500 employees, but the types of businesses that are eligible is quite broad. Nonprofit and for-profit businesses, independent contractors, sole proprietors, self-employed workers, all of those are eligible. And MoFi is providing Paycheck Protection Program loans up to $250,000 per business. And available to businesses anywhere in Idaho, as well as across the Northern Rockies. So again, if you think that you are in need of some relief funds and you have maybe assumed that you aren't eligible, reach out to us to learn more and see if you might be eligible. The second thing I want to talk about is probably the bread and butter, what so many people have known MoFi for since we got started, and that is small business loans. So we provide business loans to what we call nearly bankable businesses. We have flexible terms around things like collateral and credit and equity. So our financing can be a really nice fit for someone who goes to a bank and finds that they're just outside of the bank's eligibility requirements. Sometimes we do partner with banks. So if a bank is comfortable doing part of a loan, we can come in as a partner and do another. So we work very closely with traditional financing institutions. We also provide free consulting services to our business loan clients to ultimately help them be successful business owners and get to a place where they can get back to a traditional bank relationship as quickly as possible. obviously, what does all of that mean right now in this, in the context of what Robert has set up? And like a lot of lenders, we are reevaluating what lending looks like in the uncertainty of these times that we're facing. We think that in general, we still are largely focused on what we've always done, which is helping businesses that are not able to access bank financing. Right now, we think that that means there are a lot of businesses out there that, 3 months ago would have been able to qualify for a bank loan, but now are not able to. So we are, if something has shifted them out of bankability, we might be a really nice fit for them for a business loan. Scenarios that we're likely to continue doing, just as we always have with our business lending, include existing businesses that need help with working capital or with an equipment purchase. We are going to have a harder time looking at things like a startup right now because we look at projections and it's a lot harder to understand what a projection for a new business would look like in this current climate. We also aren't doing as many business purchases because assessing business valuation is more difficult. At the end of the day, though, if you are an existing business owner that is looking for financing to grow or purchase equipment, and you are not able to get what you need from a bank in whole or in part, give us a call. Jumped ahead here. I also want to touch on new markets tax credits. This is a photo of Steve Foltz, who is the Economic Development Director in Caldwell. We have worked with him on a couple of projects in the Treasure Valley. Holistically, the New Markets Tax Credit Program is a program administered by the U.S. Treasury, and it is designed to incentivize investment in economically underserved areas by supporting businesses and real estate developments that have catalytic community impacts. Nationwide, about $50 billion worth of projects have been completed in low-income areas using New Markets Tax Credit enhanced financing. MoFi is using this program actively in Idaho, and I'll tell you a little bit more about what that means. So we like to think of New Markets Tax Credit financing as financing to help make catalytic projects a reality. At a high level, New Markets can provide a subsidy of up to 20% of a project's total costs, and that subsidy comes in the form of a low-interest loan that ultimately can be forgiven. How it works is that MoFi applies for the tax credits to the Treasury Department through a competitive application process. If and when we receive the tax credits, we then turn to the communities that we serve and look for projects that have economic and community benefits. When we find those projects, then we partner with an investor, usually a bank, and then we sell the tax credits to that investor. We take the proceeds of the sale from the tax credits and put them into the project as that low interest equity piece. It's 20% of total project costs. We've helped a variety of different types of projects across Idaho, including the project that you see here, which is Premier Technology. That's an existing business over in Blackfoot that really cool business, women-owned industrial manufacturing and welding company. They needed to expand and add some new equipment in order to be able to fulfill some new federal contracts that they had secured. And New Markets was able to come in and help with a piece of financing that they needed that they didn't have in order to get the project done. If you think about generally a capital stack for one of these projects, if you have, say, a $10 million project, again, obviously $2 million of that, the 20% would come from New Markets. The remaining $8 million usually comes from a mix of owner equity and bank debt. In the case of nonprofits, you might also have foundation grants, capital campaign proceeds, things like that. So how do projects qualify for New Markets tax credits? There are a few main things to keep in mind, the most important of which is that the total project size needs to exceed $5 million. So projects can be much larger, they can be upwards of $100 million, but they need to be at a minimum $5 million, and that's all in hard and soft costs, $5 million. They also need to be located in a qualifying low-income census tract and have some sort of community benefit that they're bringing in, whether it's job creation or introducing essential community services for residents, things like that. This is a picture of another project that we financed up in Pocatello. So this was a new facility for Western States Caterpillar. Ultimately, the financing helped Western states build a new 150,000 square foot facility that would enable them to achieve some growth targets that they had set, and as well as install a training facility for employees, which is exciting to us. One other project that we financed in Shelley, Idaho, is this beef jerky manufacturer, Golden Valley Natural. And this was another existing business that had a facility in Idaho Falls, but was looking to expand with a larger facility. They identified a location in Shelley. They had a gap in financing that we were able to come in and help fill. And they created a significant number of high quality jobs in a rural area. Just a little bit about, as I mentioned earlier, this is a federal program, and every year MoFi is one of many organizations that applies for New Markets Tax Credits. Last year we had a $70 million award of New Markets Tax Credit financing, and we used that award to finance 4 projects across the region that we serve. 2 of those projects were located in Idaho, up in the Panhandle. One was a new headquarters for MZ, a labor market data technology company in Moscow. And the other project currently under construction, nearing completion, is for Mariman Health, the tribe's healthcare provider up on the Coeur d'Alene Reservation. They're building a new health and wellness facility for youth. We have applied once again for New Markets Tax Credit allocation, and we are expecting to hear sometime this month if we are successful. So if you know of a project in your community that's greater than $5 million in size with a gap in financing, give us a call. We'd be glad to talk with you and see if it's a project that might be a good fit for New Markets Tax Credit financing.
Wonderful. Thank you so much for all the information that you provided. It's exciting to see there's so many opportunities for businesses out in the community for partnerships and resources. So we appreciate you joining us today. Next, we'll be hearing from Kathleen Mogu from Crowdfund Better.
Thanks, Cheryl. And thank you everyone for hanging in there to learn a little bit about crowdfunding. It was interesting hearing the comments of some of my colleagues because crowdfunding is having a bit of a renaissance in this environment. So I'm excited to tell you about what's possible. First, let's talk about where crowdfunding fits in all of these different types of financing. And as you can see, it's about individuals and communities. So it works very differently from traditional financing. Its technical definition: a large number of people who share small amounts of not only their financial capital, but their social and creative capital via the internet within a limited time window. And who can use this? Here's the, both amazing and kind of a little bit crazy thing about crowdfunding. Any stage of business, from idea to startup to growth to established. Many people see crowdfunding just as something that is the domain of startups. And as I'll explain a little later on, that's not the case anymore. Any size of business, from solo entrepreneur to Fortune 500 companies, are using crowdfunding for market testing. You can raise a little bit of capital or millions of dollars in capital. So there are people who are raising, $1,500, and there are people who are raising $1 million. And it has really low barriers to entry. Crowdfunding is not dependent on your FICO score or your repayment capacity, your equity injection, or your collateral. So then how does it work? How do people know if they should contribute to your crowdfunding campaign? And it's really that crowdfunding is built on trust. The trust that you've built with your network becomes your currency, your character, the social proof of your company, your brand recognition, goodwill that you have created. All of that is what turns into funding. But here's the secret to crowdfunding. It doesn't matter whether you're trying to raise $1,000 or $1 million. It's where many people have a misconception, which is that this is a crowd of people that show up for you. It's really about networks. Between 50 and 90% of your backers will be something people who are in your known network. And by known network, that doesn't have to be someone who's your friend or your family. That could be someone who's on your email list, someone who's following you on social media, someone who you participate in community organizations with. But in some way, you are known to them already, and you have some ability to communicate with those individuals. Another interesting thing about crowdfunding is it's not just about the money. So yes, crowdfunding can bring you funding and growth and pre-sales, but there are a whole host of non-financial crowd assets that can help your business to be resilient long after when your crowdfunding campaign closes. You can test and build branding. You can get proof of concept, not just for a startup who is looking to test their initial product, but an existing business now who, say, after COVID is thinking, maybe I should be trying a different product. What if you could test that concept and get market validation for it before investing a lot of capital in making it a reality? You can acquire customers. Everyone who backs a crowdfunding campaign, you get their email address, and so you have just added a potential customer, not just for your crowdfunding campaign, but also going forward for your business. You can get community buy-in for your projects. You get project and brand ambassadors. We find that crowdfunding backers are loyal customers who come back again and again. You can use crowdfunding to get customer feedback to improve your products and services, for research and development, to develop your marketing assets, to get PR. It's also a really great tool because when you put your message out into the world, you find others who didn't know about what you were doing. So there are businesses who find partners. And it's also been used as leverage for grants and investors and for both nonprofit and traditional loans. So you probably have heard of certain types of crowdfunding. I wanted to take you on a tour of the entire ecosystem because I think that there's a potential place for most businesses, and you just may not have heard of it. So there's 4 main kinds of crowdfunding: donation, rewards, lending, and investment. The first of these you're probably familiar with, particularly in the days of COVID, because you've seen a lot of GoFundMe campaigns. Those are donation campaigns. This type of crowdfunding is also used by nonprofits and social enterprises, and really all people are looking for in exchange for their contributions is knowing that they've done some good or a tax-deductible write-off. Then we have crowd lending, and you may have heard of Kiva. Kiva is the platform that really leads in this space. They offer no interest loans. Well, they're not offered. You crowdfund from your community a no interest loan, and under the current circumstances, they have raised it from $10,000 to $15,000. So it's a 0% no interest loan that you crowdfund from your community. Then there's rewards crowdfunding. This you've probably seen Kickstarter campaigns or Indiegogo campaigns, or have artist friends who have used tools like Patreon. There's film crowdfunding. And what this kind of crowdfunding, you are accepting contributions in exchange for rewards or perks. It's often used for pre-sales. I want to make sure you understand that this type of crowdfunding, the individuals who contribute do not become investors in your business. Once you provide the perk or the reward for what you have been raising the money for, you do not owe them anything beyond that. But often those individuals will be very interested in your company, what you're doing. This can be used for ideas and for startups and existing businesses, and even nonprofits have used rewards crowdfunding. To give you an example of a business here in the Treasure Valley that's used rewards crowdfunding, this is Terry and Mike Landa of Idaho Kombucha, and they used rewards crowdfunding to fund the purchase of equipment. They wanted to expand their bottling capacity for Idaho Kombucha, and they raised that money through pre-sales to their community. The newest type of crowdfunding, and where I'm going to spend a little more time, is investment crowdfunding. This is, yes, the ability to offer individuals equity, debt, or revenue share securities in your business. It's subject to federal and state securities rules. and your backers will be investors in your company. You can use this for startups, existing businesses, and real estate projects. The story behind investment crowdfunding is that prior to the Jobs Act of 2012, it was illegal to advertise that you were looking for investors. And what does it mean, looking for investment? Whenever you invite people to put their money in your business in exchange for a potential profit. So in 2012, the Jobs Act was passed, and they created what they call exemptions, which are really just exceptions to having to file like you're going to do an IPO on a stock exchange. And so the three exemptions they created, one is regulation crowdfunding, and that's for raises up to $1,070,000 per year. There's Reg D, 506C, that's for what we consider accredited investors. Those are wealthy investors, as opposed to regulation crowdfunding, where anyone, everyday person on the street can now become an investor in private businesses. And then there's also an exemption called Reg A+, which is really like a mini IPO, but with less due diligence, and you can raise up to $50 million using that exemption. And I just wanted to step back for a second and talk about types of securities, because I know listening to Nabil earlier talking about different types of tools that work with certain types of businesses. And the really interesting thing about investment crowdfunding is that there is more than one type of security. And some securities are more patient and some are less patient. So you would want to work with a lawyer who would help you construct an offering to investors that not only works for them, but works for your business. What kind of security is going to provide you with the financial support that you need? And the reason I bring this up is because often when people think about taking money from investors, there's this idea that the investor sets the terms. And with crowdfunding, you, the business, set the terms for your offering, and the investors either decide to take it or not to take it. So it gives you a lot of creative space to create an offering that works for your business and not just for the investor. So here's an example of an Idaho business that's used regulation crowdfunding. This is Rhino Hide. They create bulletproof wall filler for schools. The thing to know about this is they weren't selling their product when they raised almost $500,000. They had developed the prototype, they had gotten the patents, they had potential installers, they really had all the pieces in place, and they raised capital to be able to really take their product to market. Here's another example of a debt-based, it's actually a revenue share regulation crowdfunding. This is for and this is under COVID specifically. This is a beloved music venue in Boston, and this is interesting. There is a new entity that is raising money to buy it, and they're using investment crowdfunding in order to raise the capital to acquire this property. So there's an enormous amount of creativity in this space right now. And something, Robert told us about, what's happening in the economic conditions. The thing to know is that in the investment crowdfunding space, investments are up. Platforms are seeing better weeks and months than they ever have. So my belief is that people are interested in supporting and investing in businesses for the future, individual people, not just big investors. And so it's a very interesting place to think about raising capital if you're looking to expand a business or revitalize your business. The heart and soul of it is that you bring people to the offering. Platforms don't bring investors until you bring investors. So you need to generally bring 30 to 50% of the people to your crowdfunding campaign before the mechanics of crowdfunding bring others. And this makes sense because who wants to put money in something that says zero? that says that your own community doesn't believe in what you're doing. But if your community shows up, it can also bring others to your campaign. And then there's another type of investment crowdfunding, and there are federal rules, and then there are also state rules. And so in the state of Idaho, you can do a small company offering registration or a score. You can raise up to $1 million in most states. And you can also, if your business is on the border of a couple of, Idaho and another state, you can register in more than one state. There's also the Idaho exemption by order. And a really great story of a business that has actually used Kickstarter and used a score, and then also an exemption by order, is Boise Brewing. So if you've ever visited their tap house in downtown Boise, that was funded through investment crowdfunding. So how do you know if crowdfunding is for your business? And for Crowdfund Better and what we do, we help you navigate the crowdfunding space. It used to be very small, but the ecosystem is pretty large these days. So where do you fit in it? What type of crowdfunding might you use? That's exactly what we can help you navigate. And we use initially a framework of readiness, willingness, and value. So how ready are you for the type of crowdfunding you want to use? For example, if you're looking to raise capital for your restaurant, do you have customer lists? Do you have people you can access easily and bring that offering to them? Willingness. If you don't, are you willing to do the work to build those lists? And are you willing to do the work to create a campaign? Because crowdfunding campaigns don't promote themselves. It really is in the hands of you, the business owner, to promote the business, whether you do that yourself, whether your staff that you've hired is doing that, or whether you hire a marketing agency to support that. And then value. I put that slide up with the list of non-financial values of crowdfunding. And I think it's important to see the non-financial value as well as the value, because it is going to be work to put this together. So how can you get a double bottom line, a triple bottom line value out of doing a crowdfunding offering or launching a crowdfunding campaign? As I wrap this up, because I literally have scratched the tip of the iceberg in terms of what crowdfunding is and how you can use it, I want to make sure that you know that next week we have an Ask Me Anything call that you can sign up for, and you can get your individual questions answered. So if you don't think this is the forum for that, please join us, because I really have a lot of information, but very little time this morning to share that with you. So there's my very broad overview of crowdfunding, and I look forward to talking with many of you and helping you see your possibilities.
Wonderful. Thank you so much for all the information. I didn't realize that there was so many different options for crowdfunding, so that's fantastic. We do have just a couple more minutes for some questions, so if anybody wants to ask some additional ones. There was one question asked by Michael Armstrong to the panel. Are there any major P&C insurers who are at risk of failing for COVID-19 and now the piling on of the Floyd riots? Can anybody answer that question for Michael? Or does anybody need any clarification? Michael, I allowed you to come off speaker if you maybe have some follow-up to that question.
Sure. My question really, can you hear me?
Yes, Mick, go ahead.
My question was really directed to Robert, and was just wondering, it's probably still early, but that would be a fundamental risk in our business community if we were stretching the limits of our insurers.
Yeah, it's something that, so I haven't heard about any that are specifically at that risk now. The struggle is to the extent that governments require them to cover losses. There are several businesses that have business continuity insurance that have been denied because of specific provisions in their contracts that say they do not cover pandemics. So that's one of the ongoing policy struggles, is whether they will be required to cover those. And some states are considering that. I know New Jersey is really pushing to require that kind of coverage. But this is the real struggle. If governments require that kind of coverage, then many of those insurance companies will have serious risk of default or inability to cover those. And so I would argue, if governments are going to take that move, then they need to be willing to step in and provide the backstop, the financial backstop to those insurance companies to be able to cover those losses.
Perfect. Thank you, Robert, so much. Thank you, everybody who joined our webinar today. And we'll be sending out the ebook and the video after today's session for anybody who would like to follow up with any of our panels today with any questions or further business partnerships.